Good evening to all of you. On behalf of the Institute of Certified Management Accountants of Sri Lanka, let me welcome you to this webinar organized by CMA on predictive accounting, driver-based budgeting, and rolling financial forecast. So today we are very happy to welcome our guest speaker, and of course we may call him the keynote speaker, Gary Cookings. This is your maybe the third time that you're addressing us. So we are very happy that due to the COVID-19 pandemic, we are being now connected via the internet using Zoom to USA. Otherwise, we would have been very happy to see you physically here in Sri Lanka, but I think we've now been able to connect very, very easily. So today we have with us our Vice President, Mr. Hennayaka Bandara. He's also the Vice President of the South Asian Federation of Accountants. We have Dr. Nuwan Gunratna. He is currently based in Brisbane, Australia, and of course a senior lecturer at the University of Sri Jayawardhanapura. And I think a few of our council members are expected. We also have our members who are listening to the webinar. We also have a large delegation from Nepal. So let me welcome you, and also from our other South Asian countries, because we've been able to invite them, especially with the Vice President of SAFA, Mr. Hennayaka Bandara, being here. So we are very happy that we have a number of our friends and colleagues from the South Asian countries. So today we have this very important topic on the predictive accounting, driver-based budgeting, and rolling financial forecasts. This is a little different from what we are normally dealing with. As you all know, everyone would agree that the past has already happened and reporting systems cannot change history. External users of financial information and managers are far more concerned about what will happen than what did happen. Actually, what will happen, they are interested rather than what did happen. So predicting accounting projects future financial performance using statistical understanding of an organizational processes. Predictive accounting seeks to understand the future. So we are very happy that today we have a very, very important and very learned speaker, our great friend, and also one who's been with us many times, Gary Cookings. He is an internationally recognized expert, speaker, and author in advanced cost management and performance improvement systems. He's a founder of analytics-based performance management, an advisory firm located in Cary, North Carolina. Gary received a BS degree with honors in industrial engineering, operation research from Cornell University, and he received his MBA from Northwestern University, his Kellogg School of Management. So today, Gary Cookings' presentation involves the shift from historical reporting to predictive costing, such as capacity-sensitive, driver-based, rolling financial forecasts, what-if analysis, and marginal cost analysis. The annual budgeting process is being criticized as obsolete soon after it is published, prone to gamesmanship, cumbersome to consolidate, cost center spreadsheets, not being volume sensitive, and disconnected from the strategy. So today we will have Gary Cookings. We will deliberate on how to understand the deficiencies with traditional annual budget, how to apply unit level consumption rates with forecasts to project operational expenses, how to include strategic and risk mitigation projects in expense projections, how to apply predictive accounting for capacity sensitive driver-based rolling financial forecasts, what if analysis and outsourcing decisions, and how to shift from bottom-up cost center consolidations to top-down modeling. So today the presentation would be for 70 minutes, and then thereafter we will have a Q&A session. So now I have great pleasure in inviting our keynote speaker, Gary Cookings, to address us.
Well, thank you, Lakshman. It's a privilege to present to you and your audience members, and I feel like we're friends at this point in time. I have my email address there in case there's not enough time to answer questions, or if you just want to send me a personal email with a question, I can answer it directly. And you're also welcome to invite me to connect in LinkedIn. I'm not sure everyone's muted. There is one person that I can hear their children screaming and yelling in the background. So I don't know, Lakshman, if you can mute them or if that person can mute themselves. So let's get going. Whoop. There we go. So yeah, you introduced me with my degrees. In terms of my career, it was really in what I call 3/3. The first decade was with a large manufacturing conglomerate in the US FMC Corporation Link Belt. My middle 15 years was a consultant with Deloitte, KPMG, and then Electronic Data Systems, which was acquired by HP. And then up to 8 years ago, when I retired or from SAS, I was 16 years with SAS. Many of you may not recognize SAS. SAS is actually the world's largest privately owned software vendor that specializes in analytics and data science, 15,000 employees. If you're doing the math, when my degrees, I am 71 years old, but I feel like I'm 41 years old. I still feel young. I was raised in Chicago. So many of the older people will recognize Chicago from, Al Capone, the machine gun guy, but the younger people, Michael Jordan, the Chicago Bulls basketball player. There's a reason those books are there. I think careers have more to do with luck and circumstances than being smart and competent. I had a lucky break. In 1988, KPMG struck an exclusive contract with Harvard Business School professor Robert S. Kaplan. And many of you may recognize Kaplan's name from the Kaplan and Norton Strategy Map and Balance Scorecard, which I'll talk about briefly later on. But he did the early pioneering work in activity-based costing. I got recruited from Deloitte to be trained by Professor Kaplan. For 5 years, I did nothing but implement ABC. I wrote a book. Not one of those, that led to other books. And so from that point forward, I wound up being kind of an educator. I'm not promoting the books. In fact, do not purchase my books. I'm not looking for the royalties, but if you go to Amazon or to Wiley, chapter 1 is a free download, and you can probably get the idea what the book's about by just reading chapter 1. So let's get going. Who will benefit from this presentation? Managers who have previously struggled at promoting rolling financial forecasts as an advance to the annual budget process. Managers who intend to champion driver-based budgeting and rolling financial forecasts, and they need a compelling call to action. And the reason I have champion in quotation marks is because it's been my observation that although it's nice to have the senior executive team sponsor innovation and new ideas, often they are preoccupied with firefighting and short-term priorities. It's typically a manager 1, 2, 3 levels down in the organization chart who sort of has what I call passion or fire in the belly and asks themselves, how long do I want my organization to continue to perpetuate using old and stale and arcane methods? And they're the ones who will do a pilot or a proof of concept to demonstrate to their fellow line managers and executives, this is the way to go. So if you are 2, 3 levels down in the organization chart, that's fine. I like lecturing to you. So my agenda, I'm first going to have to do sort of a primer on some of the basics of costing because it's foundational in order to do the predictive view. Then we'll talk about what's the problems with the current budgeting process. Then we'll basically shift towards how to basically move not just to the annual budget, but periodically refreshing that, maybe quarterly, maybe even monthly, to rolling financial forecast. We'll then need to basically put our industrial engineer hats on. You know, I always say I'm an industrial engineer masquerading as an accountant. I was a financial controller when I was age 27, and I've been in the CFO accounting space ever since. But we'll have to talk about capacity planning. And then I'm going to conclude with the frustration that I have, which is why is it taking so long for organizations to adopt these progressive methods? So I'm going to start with this cartoon. Drowning in data, but starving for information. You have this poor, beleaguered clerk, you know, shoulders hunched, sad, paper all around him. And the supervisor in the doorway to the left is asking him, it looks like you've got all the data. You know, what is the holdup? I gave you the request this morning. How come you don't have the answer this afternoon? And the real message here is there's a difference between data and information. You have lots of transactional data from purchasing systems, payroll systems, invoicing systems, but you convert the data into information to get insights to make decisions. So we're going to have to do a little bit of a primer on activity-based costing. To understand how to perform driver-based budgeting and rolling financial forecast, we first need to get a little educated about ABC because it's foundational to do the calculations for the predictive view. So this is going to be a bit out of your textbooks. What really is most desirable is to have direct costing, okay? But ideally, you know, they all should be directly charged, but as variety, complexity, and technology increases, more and more of the expenses and costs are indirect and shared, commonly called overhead. What I'm showing you here is a spectrum from left to right. The highest form of direct costing is project accounting, but it only applies when there's non-repeatable processes. So like in a manufacturer, a make to order, engineer to order, you know, like building a satellite one time. Then we move to standard costing, you know, which is the traditional view. And I know some of you are saying, oh, this looks like it's a manufacturing presentation. No. In fact, surprisingly, in the United States, only 8 out of 100 jobs make products. The other 92 deliver services, banks, insurance companies. Everything that I will talk about today is universal, whether you're a service organization without tangible products or manufacturer distributor. Activity-based costing, the third one to the right, is what I kind of call the poor person's standard costing system. It isn't as quite as complex, and you'll see what it's all about. The real message here is we don't want to do allocations, the fourth one to the right. And you'll be saying, oh, the semantics here. Allocations, which I'll talk about, is where, you know, you allocate the indirect, like spreading butter across bread. You know, we frown on that because it gives flawed and misleading information. I'll describe that soon. In fact, I'm going to describe ABC right now in a way that hopefully you can understand it. Imagine you go to a restaurant with 3 other friends. You order a little salad. The other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill to pay, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair. This is not equitable. Well, that's how products and standard service lines feel in an accounting system when the accountants take this large amount of indirect and shared expense, commonly called overhead, and allocate it to the products and services, like spreading butter across bread. They use factors like direct labor hours, number of units produced, sales amount, number of employees, head count, square feet, square meters. None of those allocation factors reflect the real consumption that the products and service lines consume of the end-to-end business processes and the work activities that belong to them that consume the salary expenses and purchasing expenses. So if you were to, I'll talk accounting here, decompose the indirect into cost pools and trace and assign them with the driver with a cause and effect relationship, causality principle, you'll discover, compared to that flawed standard costing system, some of the products and service lines have been overcosted and the others must be undercosted because it's a zero-sum error game. Oh, and yes, okay, that satisfies the external statutory reporting for the auditors like Ernst & Young and Pricewaterhouse and Deloitte and so forth, but it's wrong in the parts. So the simple definition of activity-based costing is as if the waiter or waitress brings 4 individual checks. You only pay for what you consumed. So the interest in ABC has basically increased over the last 30, 40 years because of this diagram. It shows the 3 universal components of any organization's expense structure. The direct recurring labor at the bottom, and I deliberately call it recurring because some of the service organizations, they don't want to think manufacturing, but they have repeatable frontline workers, the direct material, and then the indirect expense. Now, when you ask people, why is the indirect displacing the direct? People will say, well, automation, computers, robots, we're automating out the frontline workers. That is secondary. The main reason for this displacement is over time, all organizations have had an increased proliferation of different types of products, manufacturers, more colors, more sizes, more ranges. Banks have more types of depository accounts, insurance companies, more different types of policies. The point is this: whenever you increase the diversity and variation of the outputs, it just produces complexity. And complexity causes the need for more and more indirect expenses to manage it. So 40, 50 years ago, when you didn't have all that proliferation, the majority of the expenses were direct. That was fairly accurate. You could butter spread the indirect. But today, that's not the case. The indirect overhead is very substantial, and therefore, we need to trace and assign it using activity-based costing principles. So the issue here is most organizations know what their resource expenses are. They get them from the general ledger, but they don't know what the process costs or the activity costs in them and the eventual outcomes. The problem actually starts with this traditional responsibility cost center statement. Every manager on the planet Earth recognizes this statement. But when the manager receives the statement, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control? And their answer is not much. In fact, you'll notice at the bottom I say, when managers get this kind of report, they are either happy or they are sad, but they are rarely any smarter. And it's not that the report's a bad report. It's a good report. It's just that the data is not structured in a way that one can answer the questions. So what ABC does is, notice the middle column, it converts the 914,000 US dollars into the language of work: key scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. And then it reassigns the work activities in total, the 914,000, into the products, service lines, channels, and actually customers, just like the waiter or waitress in the restaurant giving you the individual checks. And what a lot of people learn when you do ABC is that they usually think that the expenses start at the left side. But what they learn is it actually is the opposite. The expenses actually begin at the right side. The products and services and customers place demands on the workload in the middle, and then the workload draws on the spending, the capacity, the budget to the left. So demands on work flow right to left. Costs measure the effect in the other direction, left to right. Rules are many, but principles are few. And costing is a principle just like speed of light or gravity. You can't violate universal principles like that. However, many CFOs do violate it when they allocate, like spreading that butter across bread. Now, I've rotated the previous slide to the left 90 degrees because it's not a little more complicated than just taking, oh, we take our ledger expenses, convert them into work activities, and then assign them to cost objects. No, the right side is more realistic because you have support activities that support other support activities that ultimately support the frontline activities that interact with customers or make products. So it needs to be a multiple stage cost assignment network. And I want to manage your expectations. The next slide is going to look very complicated. I'll go through it briefly, but you could go to my website, see at the bottom left, wgarykokens.com, and there will be in the tabs a free download of a statement of management accounting article I wrote for the Institute of Management Accountants in the US. I'm a 30-year member of the IMA in the US. Here it is. It has the three universal components of any organization's expense and cost structure. You've got the resource expenses at the top, see salary, material, phone, travel, and so forth. You've got the work activities in the middle, and then they eventually pile up at the very bottom ultimately into the customers and the business sustaining. Now you have to adjust your thinking here. This is not a process flow chart with swim lanes, end to end. It's a reassignment network. So if the organization, let's say, spent $2 million or euros or drachma, in January, it will be the exact same $2 million of work activities, and it will pile up exactly to this $2 million into the customers and the business sustaining. Business sustaining, bottom right, it's a special category. There will be some expenses that have nothing to do with making products or interacting with customers. An example is like the legal department or the accounting department when it's closing the books. It's not traceable to a product or customer. So we create a cost object there like senior management. They're like an internal customer so that we don't overcost the products, or the customers. Typically, that'll be 10 to 15% of an organization's monthly expenses. All of those vertical arrows, think of them as thin straws or wide pipes, where the diameter reflects the amount of money flowing through. That's why it exactly reconciles. In the middle work activities, you'll notice we have people activities and we have equipment activities. Men and women run machines, machines make products. Men and women drive buses, buses deliver passengers. So equipment, assets also do activities. The message here is costing is modeling. Costing is not T accounts and journal entries from a general ledger. Direct costs, not broken. You may have data integrity issues there, but you can solve those later. So the result when you do ABC is it resolves the error. So in this graph, the horizontal line, see traditional costing, that's the way probably most of you are doing your costing, butter spreading. But the vertical axis is the percentage of error that is revealed when you do ABC. So to the far left, that's the simple products and services. That's like you in the restaurant ordering the salad. If you split the check evenly, you'd be subsidizing the other three who purchase much more. And they're on the right side. They're the ones where it's really the product, there'd be hidden losses because it's under costing. Remember, it reconciles exactly. So that's the magnitude of the error. And it's not just 5 or 10%, it can be 30, 40% difference. This slide is far more important. What does one see after you do activity-based costing? And you're looking at actual information here, okay? This is from a company that had about 900, it was a folding chair company, okay? The vertical axis is the net revenues minus the properly traced and calculated ABC costs. The horizontal axis is the cumulative buildup of the profit, but it's rank ordered starting with the most profitable product, then the second most profitable product, and so forth. Ultimately, about 3/4 of the way, it's got 600 products, and then to the right side, we have unprofitable products. The very last data point will exactly reconcile with the profit and loss statement. So in this example, it was 30 million in sales, 28 at expenses to net out at 2. And the last data point is 2. There's always organizational shock to the management team and the line managers when they see this, what we refer to as the whale curve, because notice it looks like a humpback whale. Because in this case, it said, look, you made roughly $8 million of unrealized profit on 3/4 of your most profitable products, but you lost $6 million on the remainder to net out on 2. And they can't believe it because their belief system is the reports that they've got is this little blue line with this little hook on the end with a little bit of unprofitable products. And what's happening is all that butter spreading of the indirect expense and overhead is crushing and suppressing, flattening out, resulting in the blue line. But the ABC multi-stage cost assignment network is detecting all the diversity and variation. It's estimating those driver quantities and so forth. So the top line is the truth, the blue line is false. Now, some of you may be saying, well, wow, that's a lot of unprofitable products. What do you do about them? Do you abandon them and drop them? No, that could be a mistake because some companies deliberately have what are called loss leaders. The price is actually below the cost, but those loss leaders are associated with other winners on the left, like blades and razors, for example. Also, accounting does a terrible job with life cycle costing. It's always period costing, January, February, March. So if we have a new product that's just been released, it's in a shakeout period with extra work, maybe not much sales volume. When we calculate the model, it'll say it's unprofitable. But when we refresh the model, it will migrate to the left side. But the point is this, the top line is fact-based data. And if you remember anything from this webinar, remember this. In the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of your boss or the boss of the boss up in the org chart. So to the degree that those men and women up there are making decisions on gut feel or intuition, or flawed and misleading information like the blue line, your organization is at risk. Now, some misconceptions about activity-based costing. Many believe that activity-based costing can be complex and that an organization needs to determine if the benefits are worth the effort to do ABC. Many have this perception, but it is a misconception. I next describe why this is a fallacy and how this problem can be resolved by right-sizing the ABC system to be just good enough, reasonable accuracy, not perfection, not precision. One reason that many perceive activity-based costing to be excessively complex is because in the 1990s, accountants and consultants way over-designed the ABC systems, well beyond the point of diminishing returns, of higher accuracy for the extra administrative levels of effort to collect the data, calculate the data, validate the data, and report the cost information. The ABC models were not understandable by employees and managers. They were so large that they collapsed under their own weight, and they were unsustainable. Sometimes the executives pulled the plug on the ABC implementation even before completing it, saying, oh, it's just another meaningless exercise by the accounting bean counters. The ABC rapid prototyping with iterative remodeling implementation approach resolves this problem. And I'm going to describe this rapid prototyping for you in just a few minutes. ABC production system can then be implemented in weeks, 2-3 weeks, not 6 months or a year. And here's what a rapid prototyping is all about. And incidentally, if you want to learn more, I am partly retired. I do coach and train consulting firms and companies how to do what I'm about to describe. You start with Model Zero, deliberately called Model Zero. It's a 2-day workshop with 5 or 6 cross-functional employees in a room, and you quickly construct a high-level ABC model for the last year's fiscal year, January through December. Okay, then in the afternoon of the second day, you bring in their fellow line managers and executives. They see the model. It's very engaging because it's their own company. It's not a fictitious, kind of like training case study. and the light bulbs go on with everybody. Oh, that's how we could validate our pricing and our profit margins. Oh, that's how we could understand our operational costs. Oh, that's how we could understand what really drives costs. Oh, that's how we could basically do benchmarking with apples and apples, not apples and oranges. Oh, they get it. It's accelerated learning. After that 2-day workshop, you take a week, you decompose the model a little more deeply, you start replacing some of the percentage estimates with quantity data. Maybe you do that one more time. Within 3 or 4 weeks, you're at the pyramid to the right, a permanent, repeatable, reliable ABC production system that can be revised every quarter, maybe every month. The message here is make your mistakes early and often with the iterations, not later when the system is too difficult to change. And the reason that rapid prototyping works has to do with this diagram. The vertical axis is the accuracy of what you want to know. Let's just say I want to know accurately what do our individual products or service lines cost. The horizontal axis is the level of administrative effort to collect the data, calculate the data, validate the data, report the data. You'll notice that there is an asymptotic curve. That's the black line. It goes up very quickly, hits the elbow, and then moving to the right, you get diminishing returns on extra accuracy for the extra level of effort. Excuse me. The message here is stop when they hit the elbow. It's good enough. You know, this is management accounting. This is not external financial reporting for statutory purposes. Yes, if you get the external financial reporting wrong, you go to jail. But if you get the management accounting information wrong, you don't go to jail. So, you know, don't get so concerned about precision and detail. Make it good enough. Notice at the bottom, I say, is the higher climb worth the better view? The benefits from rapid prototyping include accelerated learning. Everybody starts to understand, oh, this is a better way to resolve all that butter spreading of the indirect overhead. It solves the thorny leveling problem. Oftentimes when a CFO embarks on ABC, they think, oh, are there going to be 3,000 activities or 2,000 activities? No, it's typically only 50 or 60 or 70. It prevents that over-engineering that caused the bad reputation from the 1990s. Peer group, predetermining use of information. I didn't mention this. In the afternoon, after everybody's on board, I then ask the managers in the room, when this system is released 3 weeks from now, what decisions will you make with it? How will you use it? Oh, I'll validate pricing. Oh, I'll do benchmarking. What we're doing is we're getting them to commit that they will use the ABC information once we produce it. Rapid prototyping replaces all those misconceptions. Oh, timesheets. They think everybody needs to fill out a timesheet. Employees hate timesheets. You don't need timesheets to basically calculate ABC. So now that I've given you the primer, you needed those basics, let's go to budgeting. Here's the problem. The budget is typically a fiscal exercise done by the accountants that has these two problems. It's disconnected from the executive team strategy, and it's not based on future driver volumes. So let's see how many of these apply to your organization. If you were answering these questions, which ones would you check the box? Our budgeting process is invasive and time-consuming with few benefits. Our budgeting process takes 14 months from beginning to end. Well, maybe 6 months or 3 months that you start before the end of the existing fiscal year. Our budgeting requires 2 or more executive tweaks at the end, meaning once you produce the first draft of the budget, the executives say, oh, I don't like it. There's not enough profit. Go back, change some of the numbers. It's obsolete in 2 months after due to events and reorganizations. You publish the budget in January, and by March, it's out of date. It starves the departments with the truly valid needs. You know, something is happening in this next future year where a department is going to have a much bigger workload, but we don't give them the more headcount. It caves into the loudest voice and political muscle, which rewards the veteran sandbaggers who are experts at padding. You know, there's going to be managers like me, 50 years and older, gray hair, bald. They've been with your company 20 years, they know the game. Oh, I'm going to add more expenses just in case something goes wrong next year, and then I've got cushion, I've got a buffer. It incorporates last year's inefficiencies into this year's budget. You know, our end-to-end process is inefficient, but basically it's going to continue to be inefficient in the future year. The last one's the one that bothers me the most. When a manager is on a glide path, like an airplane landing, 3-4 months from the end of the year, and it doesn't appear that they're going to spend all of the budget that was allotted to them, what do they start doing? They start spending unnecessarily, crazy, stupidly. Why? Because they know that the next year's budget for their department is going to be pegged to how much they spent this year. We call it use it or lose it spending. And the problem is spreadsheets. I bet I'm going to describe what I'm about to describe is how you do budgeting in your organization. Here goes. You give every line manager an Excel spreadsheet for their cost center, January to December, detail accounts, including rubber bands and paper clips. They fill out the spreadsheet end to end for every account. Someone in the accounting department consolidates all of the spreadsheets from the manager's cost centers. They bring in the revenues. You give it to the executive team. They see it. They say, not good enough. Lower the costs. I want more profit. Everybody gets the spreadsheet back. They lower some of the expenses back to the accounting department, consolidate it back to the executives. That's better, but not good enough. Up, down, up, down, up, down, up, down. Gee, you almost want the executives to answer, what profit level did you want in the first place? However, that would be an interesting question to know their aspirations, but what we want to know is reality. And this spreadsheet is not the way to go. I call it spreadsheet budgeting. Here's an example of one of the manager's cost center. You know, we project to the end of the year, column B, then let's give them a 5% increase, maybe for inflation for each account. So column C is column B times 1.05 and then copy down in Excel. I hope some of you are laughing. You should be laughing. This is ridiculous. This is not the way to go. What if this department's going to have an increased workload next year? We're not going to give them enough employees. They're going to be shorthanded. What if this department's going to have workload that goes away? They're going to have too many employees. Here's part of the problem. And then I'll get into how do we move to rolling financial forecasts. I love this cartoon. The vertical axis is the skill in math. The horizontal axis is what stage of life, you know, so if you're 5 or 10 years old, you know, a little mummer counting, you know, then the next box, basis operations, you know, multiplication, division, subtraction. Oh, then we get to the geometry. Oh, now we're into grade school. We're into algebra. Boy, now we're into college, trigonomic functions, complex. Wow. By the time we're at the end of college, advanced calculus, now you're back on your job, back to spreadsheets. How do we basically resolve the problems with budgeting? It's the shift to rolling financial forecasts. The way we want to determine this, and the budget is broken, and I'm not saying stop budgeting, but I'm saying, what can we do to replace the purpose of a budget with a different methodology? The level of spending, the integrated budget to the right, is the result of 2 river streams coming at you. The upper river stream is the recurring, repeatable work. It will be demand driven, typically customer demand, the forecast of what volume and mix all the customers will be buying of all your products and services. The lower river stream is the non-recurring expenses, the non-repeatable work, and that's going to come from projects. And I'm going to give you a little bit of advance. There'll be 3 types of projects: capital projects, risk mitigation projects from risk management, strategic projects. Let's start with the upper river stream. For the operational expenses, the things that are repeatable, what we want to do is do the activity-based costing for the past period, but now for the future period, the predictive view, we want to forecast the volume and mix, multiply them back towards the unit level consumption rates that were calibrated from the past period to calculate what level of capacity we need, how many and what types of employees and their salary and wages, and how much to spend with suppliers, okay? So what I'm effectively saying for the operational, the upper river stream, if you remember this diagram, when we calculate ABC for the past, we then now calculate it backwards. We start at the bottom of the spreadsheet and calculate it backwards using the unit level consumption rates. So another way to look at this is the historical view. The expenses were known exactly to the penny, to the euro, to the dollar, to whatever the currency of your country. We calculate the activities and the products, services, and channels. Typically, ABC is strategic. You know, we want to know where do we make or lose money. We even want to get customer profitability for each customer. Which types of customers are most attractive to retain, to grow, to win back and acquire? Which types are not? But we get a bonus when we do the historical costing. We get the unit level consumption rates. What's the cost per type of order? What's the cost per type of blood test in a hospital? Then when we go to the predictive view, and this is what I call industrial engineering 101. I think it was my second semester, my freshman year at Cornell University. The demand, volume, and mix of sales times those unit level cost consumption rate equals the capacity required. For example, the number and type of employees and their salary and wages, purchases with suppliers. Remember, you've got to think like an engineer, okay? Now, let's talk about the lower river stream, the three types of projects. I'm going to give you a quick primer about strategic management and the Kaplan and Norton strategy map and balance scorecard. Some of you may be familiar with this. If you're not, just Google it and learn about it. Kaplan and Norton created the strategy map, I think in the 1980s. What they recognized was that executives were overreacting to financial results reported at the end of the period. They said, you need to shift your attention to non-financial metrics collected during the period. And they created this perspective, this strategy map that starts at the bottom with cause and effect relationships. You begin with, and each of the boxes you're seeing, those would be strategic objectives. So we start with learning and growth. If you're accomplishing them, they'll contribute to the 4 internal business process of strategic objectives. If you're accomplishing them, they'll contribute to the customer satisfaction, retention, loyalty, and then ultimately all the way to the top to the financial strategic objectives. Another reason of the strategy map is most employees don't understand the strategy. And this is a way that the executives can communicate the strategy of their organization to the managers and employees in a way that they can understand it. Each of those arrows, those are KPIs, key performance indicators. You know, you get what you measure. You can't measure it, you can't manage it. Can't manage it, you can't improve it. So to summarize what a strategy map is, you start at the bottom. A learning environment will stimulate process excellence. Process excellence will lead to the customer intimacy, satisfaction, retention, loyalty. That'll create the value. Now, in each of those strategic boxes that you just saw, there's really 5 components. They are the columns in this slide. And what this slide is showing is who is responsible for which, the executive team or the managers and employees below them. Well, defining the strategic objectives, of course, that's the executive team job. You know, their job is to set direction. Their job is to basically answer the question, where do we want to go? But increasingly, when developing a strategy map, and instantly you email me, I have another technique that can implement the strategy map and scorecard in one day. I'll tell you how to do it if you email me. Delegate the next step to the managers and employees. And that second step is to identify what are the few and manageable projects or initiatives, or in some cases, core processes we need to get better at. And then next, have those managers and employees identify what are 2 to 3 key performance indicators that we can monitor to see the progress of accomplishing the strategic objectives. When we get back to the targets, now we're back to the executives, because this is really about incentives and motivation. Remember, you get what you measure. So if the managers each have their individual assigned KPIs and they're held accountable for them, they're striving to reach the target. Now, let's say that we don't give any money to the managers for those projects and initiatives. What's the consequence? Well, two things, and they're both bad. If you don't identify the project, if you don't fund and put money to the project, you don't accomplish the strategic objectives. And this may surprise you. Many executives, they're good at formulating strategy. Their frustration is failure to execute the strategy. And in the United States, there is increasing turnover, firing, terminations of CEOs because they're unsuccessful at implementing the strategy. A case example with Hewlett-Packard was Carly Fiorini. The board of directors gave her 5 years. She failed. They fired her. So it's going to be a bad consequence if we don't put money into it. But what also, if the line managers are given an incentive system, bonuses, by accomplishing the KPIs, they're not going to get their bonus. So by basically funding the projects, what did we do? We now connected the budget to the strategy. We've connected the strategy to the budget. That solves that problem. Next project, enterprise risk management. Increasingly, the enterprise risk management community is integrating with the enterprise performance management community, and that's where management accounting fits in. And this is a popular grid that the risk management community uses, managers. Each of the circles you see is basically a risk event that could occur in the future. The diameter of the circle reflects how much money would mitigate that risk from happening. Okay, the vertical axis is the severity of the impact on the event occurrence if it was to happen. The horizontal axis is the probability of this risk event happening, from low probability on the left to high probability on the right. So when we're in the upper right corner, the shaded blue circles, all right, let's fund those, put money into those so that we mitigate the risk happening. Now, you can't budget every risk. At some point, it will impact, the profitability. So let's revisit our river streams. I've decomposed it. For the upper river stream, the recurring repeatable work, the solution going forward is do the activity-based costing to calibrate your unit level consumption rates, forecast the future 12 months volume and mix, multiply times the rates, solve for the capacity required. For the bottom river stream, the project-driven, do the risk mitigation, as I just showed you, do the strategy map and the balance scorecard to identify and fund the projects, and then capital budgeting, which you're all familiar with. Add them all together, we're going to get a much better number than those spreadsheets, up, down, up, down. Now, the next slide is going to be a decomposition. It'll look a little complex. I'll go through it slowly, but you will all receive the PDF of this presentation so you can examine it. The shaded boxes to the right are the upper river stream. Remember, the recurring repeatable work. The unshaded ones to the left are the ones for the 3 projects. Put your eyes at the lowest shaded box. See where it says derived budget and rolling financial forecast. I use the word derived because we didn't do these spreadsheets. Look what's going into it. From the top is the operational budget. From the left is those 3 projects: capital budget, strategy budget, risk budget. For the upper river stream, basically what we've got is the management accounting system, gives us the unit level consumption rates. From the left comes the forecast, volume and mix times rates equals the capacity required. Number of person hours, pounds, kilograms, number of employees, and then we monetize it using whatever currency is of your country. From the left, I already described them. This is so much better than doing those spreadsheets by cost centers, up, down, up, down. But you'll notice I have a diamond at the bottom right. We have the same problem with the traditional budget. When we give this number to the executives, will they accept it? They may not. There may not be enough profit there. So they're going to say, go change something. Well, here's the problem. One of the temptations to lower the expenses is, well, let's postpone or eliminate the risk mitigation. Let's postpone or eliminate the strategy budget. Let's eliminate or postpone the capital spending. Bad. Those are all three bad, because we'd expose ourselves to risk. We won't achieve the strategy. The CEO will get fired. There's only one lever that you can change here, and it's the unit level consumption rates from the top. What that means is productivity. Next year, the processes need 2%, 3%, 4%, 5% improved productivity. I lived in Detroit, Michigan for 15 years. I can tell you, in the automotive industry in the United States, the big automakers, Ford, General Motors, Chrysler, they pound on their tier 1 and tier 2 suppliers to actually have percent decreases in the pricing for their model years. So those suppliers are very, very good at constantly having to have productivity improvements year by year. I'm not sure the companies in your country are doing that. So let's talk about forecasting. Don't treat forecasting as a special event. I love this cartoon. You have these 3 men at the table. They said, we haven't forecasted in a while. Maybe we should try that again. Forecasting should be an ongoing part of monitoring the business. You should reforecast quarterly, maybe even monthly. And this diagram shows the accuracy of a forecast over time. The vertical axis is the accuracy, the horizontal axis is time. You'll notice every forecast is 100% 1 minute after you forecast, but then 1 day, 1 week, 1 month later, it gets less and less accurate. So the idea here is keep refreshing the forecast so that you always have better forecasts of the volume and mix from the customers of all the products and service lines. And then put it back into the two river streams that I just talked about. Because actually, I'm going to go back. You'll notice in this diagram, there's only one independent variable. It's the forecast. All the other variables to produce this have been calibrated, or estimated. So if I basically refresh the model, this calculation, every quarter or monthly, and go out 18 or 24 months, don't just stop at the end of the fiscal year, I'm going to get a pro forma income statement and balance sheet. And if I've got a pro forma income statement and balance sheet out 24 months, what is the next step? Net cash flow. And with this whole COVID pandemic, I'll tell you, in the United States, what board of directors are most interested from their CFOs because of the chaos and disruption from the pandemic is, what is our net cash flow going to be? Are we going to have to borrow? Are we going to be able to afford borrowing? Are we going to be bankrupt? Or are we going to be lucky and have surplus cash? That's why we want rolling financial forecasts. It's ultimately to be able to calculate net cash flow month by month out 24 months. I say, don't just basically budget to the wall, meaning the end of the year, the fiscal year. See the upper one, we've got January and February. All right, we forecast the next month, 12 months. Then the second one, now we've got 5 months in. All right, forecast out. Don't stop just to the end of December. Go all the way out 24. Now we need to put our industrial engineering hats on. Resource capacity planning. Capacity only exists in the resources. In the multi-stage cost assignment network, above at the top, those are expenses. Everything else is a cost. Costs are calculated. Expenses and costs are not the same thing. Expenses are when the organization exchanges money with third parties or pays employees. Currency exits the treasury like a check in a checkbook. all costs are calculated, process cost, product cost, so forth. Now, in the very short term, you would not fire or terminate employees on Tuesday due to the low workload that's in the house, but hire them back on Wednesday. You'd keep them for the extra day. You'd have some unused capacity. But going out into the future, you may replace some of the full-time employees with temporary contractors, or you might lease assets that you might have purchased. So in this way, so-called fixed costs start becoming variable. So the box at the little diagram at the bottom, the vertical axis is the effort level to adjust capacity up or down. The horizontal is short-term, medium-term, long-term. So you'll notice in the very short term, it's very difficult to adjust capacity. Again, you're not going to add an employee, remove an employee every day. But as you go out weeks, months, years, it becomes more manageable. And in the long term, geez, it's really easy. I even like to say when a company goes bankrupt, even the CEO became a variable cost. So to put this into context, when we look at the historical view, we're not basically classifying fixed, variable, any of that stuff. We're basically strategically calculating profit margins. But in the predictive view, going forward, notice what we're doing is we're classifying each of the resources in the capacity, types of employees, assets, as sunk, fixed, step fixed, or variable. And step fixed stands for resources come in discontinuous amounts. You can't buy a half of a machine. You can't hire a third of an employee. It's all or nothing. But the key here is the classification of a resource depends on the planning horizon. So remember, in the short term, it's basically resources are fixed, but as we go out days, weeks, months, they can be replaced, they can become variable. My message here is it's like microeconomics when we go to the predictive view. You got to think like an engineer, not like an accountant. So we have to use marginal and incremental analysis because sunk costs and fixed costs, if you ever remember from your textbook, we only look at the relevant range. And most savvy managers, the higher level executives, they know that some of the expenses are fixed in the short term and variable in the long term. They want to know only the financial impact of a decision. If the expenses are fixed or sunk, don't include that in your analysis. So examples of basically this predictive view would be adding or dropping products, channels, or customers, make versus buy decisions or outsourcing decisions with a third party, capital investment justification when you're basically doing the analysis, will the payback and return on investment from buying this machine, and the rolling financial forecasts that I just described. So the classification of a resource also depends on the type of decision, in addition to the planning horizon. So if you look at the left column here, I've got 4 categories at the bottom: sunk, fixed, step fixed, and variable. So let's imagine that a large customer of yours has come to you and said, I'm going to order this purchase from you, but this is the price that I'm going to pay and I'm not going to budge. Do you accept or reject that customer's order? Well, if that customer's order price is $1, €1, or one whatever, just a little bit higher than your currency, of course, accept it. You just made a little bit of money. But if they then call back the next day and say, we're going to repeat this purchase every month for the next 12 months, well, you got to start thinking about, wait, that means there's going to be impact. I got to add capacity and so forth. It's not as clean. That's why as we go from operational to strategic, we need to be clearer and clearer about using these mechanisms. So what I'm going to show you now is a diagram that I created for the International Federation of Accountants. You can look up IFAC. They're in New York City, 50 employees. Their website is ifac.org, www.ifac.org. IFAC.org. The International Federation of Accountants is like the United Nations of accounting institutes. I think they have 180. I'm not sure that the ICMA of Sri Lanka is a member. You may be, but in the United States, the Institute of Management Accountants is, the AICPA is, many other countries. So they asked me, could you create a taxonomy, just like in biology, plant kingdoms, animal kingdoms, and the like. And I created this. It's a 30-page paper. Again, if you go to my website, bottom left, Gary Kokens, you'll see it as a tab. You can download free PDF, the 30-page paper that describes this diagram. But briefly, let me describe it. The three kingdoms in the taxonomy are tax accounting, financial accounting, that's the external, statutory, and internal managerial accounting. Now, I already mentioned that when you calculate costs, they are a calculation. So we got the cost measurement. When we go to the left to cost accounting under the financial accounting, notice I have GAAP. That acronym stands for Generally Accepted Accounting Principles. Rules are many, but so this is what you follow the rules for statutory reporting. Example would be inventory costing. So you can do the butter spreading, that I mentioned earlier. The auditor doesn't mind. They just want it to reconcile exactly. But we do management accounting. We don't have to follow the rules. We'll basically use our own different assumptions and variables. They may be different than the external reporting. It's a little bit more work. So profitability reporting, lean, benchmarking, cost of quality, all of those things. Now, when we go to the right, decision support and cost planning, the future view, which was what this webinar was, predictive. Now we need to think like the engineer, start doing the incremental expense analysis, driver-based rolling financial forecast. We can do what-if scenario analysis, all of that good stuff. Many CPAs, many chartered accountants, when they hear me present this slide, they don't like me. And here's why they don't like me. Because at the bottom, notice I have what I call the value spectrum. Low value added to the left, in the middle, modest value added, to the right, high value add. The value of accounting increases from left to right. But for those accountants whose only job is to close the books each month and then produce the external financial reports for the executives, the shareholders, and the government regulatory agencies, I'm basically saying that's low value. The value really increases as you move from the left to the right. Now, here's my big frustration. Why is it taking so long for organizations to basically adopt these methods? Let's revisit ABC. I like to say it is better to be approximately correct than precisely inaccurate. In other words, it's better to be roughly right than exactly wrong. And when you're doing that butter spreading of the indirect expense overhead, it's wrong. I also like this one. In the land of the blind, the one-eyed man is king. Because activity-based costing gives so much visibility to all the indirect expense that's hidden under the traditional. Plus, you get to see what are all the drivers of the expense, so you can manage the drivers that will manage the costs and result in lowering the expenses. I love this cartoon. You've got this signboard, answers. There's two paths one can take. To the left, simple but wrong. The path to the right, complex but right. Notice where everybody's going in this path. They're all going to the left. And that may be many like you. You're like, hey, it's easy to allocate that overhead on sales amount or units produced. So let's take the simple way out. It'll reconcile, it'll satisfy the auditors. We need more of you to take the right path. It's a little bit more work, but not that much. Remember, I showed you the rapid prototyping with iterative remodeling. And I want to make an observation about India, Sri Lanka, Nepal, and I made this in my two previous ones. You have way too much emphasis on external reporting. Management accounting is basically a stepchild. meaning you're really not using internal managerial accounting enough in your countries. All of the attention's on external reporting. You got to basically keep that, get it out of the way, close the books, get those reports up, devote a lot more energy to management accounting. There's also a way, if you're interested, to basically evaluate the quality of your management accounting system. And this is another report that I created for the International Federation of Accountants. Again, you can find this report also in my website. I told them I can create a stages of maturity framework. And this is it. I'm going to go through it briefly. In the historical view, the descriptive view, last month, last quarter, there are 8 stages. In the predictive view, which we talked about here, there are 5 stages. I can attest to you that 95% of organizations in the historical are at a 5D or lower. They're doing that traditional standard costing, material, labor, and they're allocating that overhead, spreading butter across bread. 60, the first step up, that's where we're actually using activity-based costing principles. In the predictive view, most organizations are that 1P, that's those responsibility cost center statements. Remember each manager filling it out January to December, every account, including rubber bands and paper clips, remember up, down, up, down, up, down. Where we want to move is to 2P, 3P, 4P. We want to do, if you will, that driver-based, capacity-sensitive driver-based forecasting. So why has the adoption rate for driver-based budgeting and even all the other methods like activity-based costing, strategy maps, balance scorecard, why has it been so slow? Well, I have 3 types of barriers. The first one is technical barriers, and they tend to involve information technology. Examples are what we call dirty data or low quality data. In other words, the input information had some mistakes or flaws. But the chief information officer and the IT director, they have some tools in their toolbox that can clean and purify data. It's called extraction, transform, and load, ETL, software that does ETL. Or in a larger company like Reliance Electric in India, the company may have different hardware from Dell, from Hewlett-Packard, from IBM, and so forth. But the IT department can solve that. The second barrier is perception barriers, that it's too complex, it's too difficult, we can't afford it, okay? But I sort of demonstrated to you that with rapid prototyping and iterative remodeling, you can implement ABC in these systems in 2 to 3 weeks, not months and years. But the biggest barrier has got nothing to do with software. It's got nothing to do with systems. It's got nothing to do with methods. It's all organizational behavior. It's humans. It's people. It involves resistance to change, the culture, and leadership. And when we talk about resistance to change, it's human nature. People like the status quo. Only babies like change, changing the diaper of a baby, So what it really means, if you want to basically adopt these, you've got to think like a psychologist or a sociologist, But many of you, probably like me, you're Newtonians. What do I mean by Newtonians? Like Isaac Newton. To you, the world's a big machine. What you want is give me the levers, the dials, the pulleys, You've got to think more like Darwin, Charles Darwin, Darwinian, sense and respond, human nature. You're going to have to figure out, how do I get the buy-in to persuade my fellow line managers and executives that this is the way to go. Other barriers involve fear of knowing the truth or other departments knowing the truth. When you do activity-based costing, people are going to discover, oh, we make more profit there and less profit there. Oh, these customers are more profitable. It's a shock. And some employees, some managers don't want anybody to know that. Other barriers, fear of being measured, fear of being held accountable. Oh, I'm fearful. I don't want anybody to know these facts. And then the last one, weak leadership. There I said it. Maybe the executives that you work for at the top, they don't have, the brightest brains. I know I'm getting in trouble here. Maybe these are sensitive issues, but I'm 71 years old and I'm partly retired. I don't have to go anywhere. I don't have a company to work for, but you got to go back to your job and know some of these things and feel maybe shame or guilt. Here are some excuses, and then we'll have some time for question and answer. This is a list of excuses. We are profitable, so why does it matter? Well, guess what? You may be bankrupt soon, so it matters. We will purchase software that will fix our problems. Hey, the software that does this is not basically going to be the answer. I always say a fool with the tool is still a fool. Next, we already know our true costs from our general ledger financial reporting systems. No, you know your true expenses. You don't know your cost. You calculate cost. Next, we have done it this way forever. We don't do that here. We already know everything. It's in our heads. That's being arrogant. Next, we are a small organization. We'll worry about better methods when we get larger. Well, guess what? You may not get larger. You may be bankrupt. And also, a lot of people ask me, well, how big do you have to be to use these methods? My immediate answer is 25 employees. You don't have to have 500 or 1,000 or 10,000 employees like the big corporations. At 25 employees, you've already got enough complexity because you probably got different diversity of variation of products and services, that you've got sizable indirect expense and overhead. You can apply ABC. And even with 25 employees, many of them won't know what the strategy is of the executive team. So you want to communicate it to them with a strategy map and balanced scorecard and get some KPIs and targets. You want to achieve the strategy. Next, all this hype is just made up stuff from highly paid consultants. Well, let me defend the consultants. And there's probably several consultants that are listening to this webinar: Deloitte, EY, Pricewaterhouse, BDO, Grant Thornton. I'm on your side, consultants. Here's why. You can do something that your client can't do. You can focus. Your client, they're too busy. They're basically got all this chaos and short-term priorities, firefighting. They don't have the time to focus that you do. So consultants do serve a purpose here. And incidentally, if the consultants are listening, email me and I will share with you how you can do the rapid prototyping of the ABC and the strategy map for your clients. I like training you so you can basically implement for your clients. Next, no one looks at the reports I create, so there is no point generating better reports. That's sad, because some of you actually genuinely may be creating good reports. You got certified with your CMA from the ICMA, or, you read all the material and you give it to your line managers, the reports, and what do? They throw it into the garbage can. That's really sad. Keep going, keep trying. Next, we cannot afford better software to fix our problems. Some of the ABC software is very economical. It is not that expensive. Again, there's about 8 commercial ABC software vendors. I know their names. You can email me. Of course, SAP, Oracle, the big boys have a module, and they are expensive. But there are also cheaper ones, and you can use the commercial software, and then after you've calculated your cost, you can export them into the SAP or Oracle tools. Next, we are way too busy doing other things. That other thing is probably closing the books. It takes you 3.5 weeks out of the 4-week month to close the books. You take a deep breath, and the hamster gerbil spinning wheel sights again for the next month's cycle. Learn how to close the books in 2 weeks or 1 week much more quickly, so you've got the time to implement these methods. And finally, we do not know where to start or how to get started. Well, the rapid prototyping is a way to go. You know, start small, think big. So action steps, get educated, you know, get buy-in, you know, and you're getting educated just by listening to this webinar. Thank you very much for attending. Learn how to basically get the buy-in from your line managers and executives. The rapid prototyping, you know, iterative remodeling, start small, think big. I'm not an expert on motivational theory, but I know it's relevant. So you've got to think about the incentives with your line managers and executives. I have 3 links under the resources. The first one, which you'll be able, when you get the PDF, usually you can click on a link in a PDF. First one's a 5-minute read about how all these enterprise and corporate performance management systems fit together. The second one is actually a 8-minute video of me going through that the 2 river streams. So if you link on that, you can actually share the 8-minute video with your fellow workers. The third link is about 30 pages. It's a little bit longer. So your success depends on how well and how fast the right information gets to and intelligence gets to the right people. Again, there are my books. I repeat, you do not need to buy the books. Don't accuse me of promoting them. Don't buy my book. But if you go to Amazon or to Wiley, the book publisher, chapter 1 for these books is a free download. And you got it for free. It'll give you much of what's saying. So there is my email address, gcokins@garycokins.com. My website you've got. Feel free to email me and even invite me to connect in LinkedIn. If you do connect me in LinkedIn, please send the optional message that you attended, you know, my webinar. So Lakshman, are there anybody that's got some questions or in the chat box? Otherwise, we can draw to a conclusion.
Yeah, no, I think I've asked our moderator, Dr. Nuan. He is there. He will be really making a few comments, and he's also collected the questions. But let me say a very, very big thank you to you, because you really gone through in full detail, and some of the things that you mentioned would be the complex but right. I think all of us, by going through this detailed presentation you made, will certainly look that way, complex but right. And also I think the situation is now right in the sense that with the COVID-19 pandemic, one is forced to do things and not being able to just to stay and look around. So I think your presentation was really a very, very excellent one to all of us, because ABC, I think, will do the trick for everyone. And we need to look at predictive accounting, because it's not the normal sort of accounting that we are looking at. And management accountants, you really gave the full force, the importance of management accounting. And it's not just the looking after things and reporting, but really managing the operations and looking at the future. So with those comments, I will now invite Dr. Nuan to give a few comments, and then thereafter he will go through the Q&A and ask any questions. Over to you, Nuan.
Okay, thank you, Professor Vatawala. Now, before I comment on Gary's presentation, let me make an announcement to the audience who are joining from different parts of the world, especially from India, Nepal, Kuwait, and different parts of the world. Actually, this is the third webinar we are having with Gary. Our first webinar was held on 8th of December 2020 on strategic cost management to drive business performance in the new normal. And the second webinar was held on 18th of February this year, 2021, on lean accounting and ABC, a choice or a blend. Actually, I have posted the full YouTube video on the chat box. So if you are interested, you can have the full video. And also, I would like to invite the participants to post their questions in the question and answer box. So we have limited time. So make sure that your questions are short and direct so that we can quickly take them up. Now, coming to Gary, I think, again, your presentation is very interesting and insightful due to 2 reasons as far as I'm concerned. One is the context and the other is the time period. So when we look at the context, especially countries like Sri Lanka or India or Nepal, so we have progressive management accounting. We have progressive accounting profession, but the management accounting is not really a application of management accounting is not really satisfactory, as you correctly highlighted. Studies have shown that the management accounting is being used mainly for internal reporting or especially for internal controls. This is mainly because the top level awareness about the management accounting tools and the new developments is not satisfactory, or it's really limited. And also, studies have shown that majority of the companies in this part of the world are using conventional management accounting tools, especially variance analysis or maybe traditional absorption costing over new developments such as ABC or life cycle costing or lean accounting. So when we consider the context, your talk is really important. And also when you look at the time, we are living in an uncertain time period where we cannot have planning for a longer time period. What we need is a continuous rolling forecast, because due to lockdown, then due to pandemic or due to some logistical and also other supply chain challenges, all your plans will not work. So that we continuously need rolling forecast. So that's in that context, when we consider the time period, I think your presentation is highly relevant. So as far as the context, as far as the time period is concerned, I think today's webinar is really important for the participants. Now, Gary, let me point you one question, since we get the questions from the audience. Yeah, I see some few questions, but let me pose you the first question. Now, especially in this part of the world, we have a huge service sector. Especially if you look at the Sri Lankan context, according to the central bank report, the service industry accounts for nearly 60% of the GDP. I think this is the same for Nepal, India, or Bangladesh, or even Pakistan. Now, I have a question. I have a feeling whether we have given the due importance to service sector accounting or service sector costing. So as you explained, we can apply the ABC principles in service sector. So my question to you, Gary, is this. Now, how can the accountants apply activity-based costing in the service industry such as retail, banking, then insurance, railway, and so forth? So what are the changes needed for them to apply ABC in the service sector?
There's actually no changes needed. It's universal. Remember, I'm an engineer. When you construct an ABC model, you create what's called an activity dictionary. If you remember in my slides, I had the insurance company key scan claims, analyze claims. An activity dictionary should always be in the grammar of a adjective, verb, noun. Process invoices, move product, process automobile loan, there's a bank, process insurance policy, there's an insurance company. Once you have 2, 3, 4 activities per department, and let's say I've got 10 departments and I've got 4 of those defined activities per department, that's 40 activities. Look what I'm doing. Now there's a simple way to basically survey the employees of a department. What percentage of your time is doing the first activity, second, third, fourth. So, let's say it's 10, 10, 10, 70 or 20, 20, 60 percentages. Good enough. Once I've got the activities, now what types of services, what types of loans, which types of insurance policies, what am I doing? I'm walking you through how to construct an ABC model. And then you get what they call those activity drivers. So my simple answer to that person's question is there are no changes. You basically just, you model it, whether it's a making product or delivering services. And the 60%, it's the same thing in the United States. It's more like 90% of the GDP is services. So you don't necessarily have to be a bill of material and a labor routing. Those of you who understand manufacturing, you're still doing the same thing. Next question.
Right. Thanks, Gary. Now, next question actually goes to Mr. Hennayaka Bandara. Now, since you have a lot of experience in the financial sector, especially in the banking industry, let me ask you this question now. According to your assessment, what is the extent of application of ABC in the financial industry, or especially in the banking industry? How do they, or to what extent do the banks use ABC principles in their costing or pricing?
Thank you, Dr. Nuwan. I think as far as the banking sector is concerned, if you take the ABC system, of course, they implement only in the case of the product that they have launched, really, in general. So whatever the product that they launch from time to time, they really consider the ABC system. And I don't think that they are implementing beyond that.
Okay. If I could add, this is very special for banks and insurance companies. When you're in a business to consumer, as opposed to a business to business, B2B, when the consumer is at the end, you have to use something called customer lifetime value. The acronym is CLV. It's kind of like doing discounted cash flow on the consumers. There's not enough time to talk about it here, but I just want to raise the point. There is a technique, but when you do the customer lifetime value, because different consumers go through life cycles, small girls become young girls, girls become teenagers, they become young mothers, they become grandmothers, their purchasing behavior changes. So if you don't mind, Nuwan, we only have 3 minutes. I want to make a closing remark. You can send me the other questions and I'll answer them in a Word document and get them back. I just want to make this final remark. I think in the past, the best leaders and the best executives had the best answers. Today, I do not think that's the case. Today, I think the best leaders and the best executives have the best questions. There is too much complexity. There's too much volatility. There's too much uncertainty for the executives at the top of your organization to rely on their intuition or their gut feel or their so-called sixth sense, or the types of answers they had earlier in their career that guided them promoted to the top. They need to create a culture of discovery and investigation and tolerance for making mistakes as long as you learn from the mistakes. So I look for different types of leadership that are not like, oh, I know all the answers. It's like, no, find out from your employees and your line managers and ask them the questions, get the dialogue going. So I'm going to kind of end on that. So do some closing remarks, and it's been a pleasure, a privilege to present for my third time for you guys. And those others, the other two, I'm glad you gave the links to the two previous ones, because those who want to know about strategy map and balanced scorecard, they can watch that webinar.
Gary, there is just before we close up, just 2 minutes, I will invite our Vice President, Mr. Hennayaka Bandara, to give the vote of thanks, because that's a normal tradition. Okay.
Thank you, Professor. Ladies and gentlemen, on behalf of CMA, I'm glad to propose this vote of thanks after a very successful webinar conducted by Gary. As mentioned by our president in his welcome speech, Mr. Gary is not a stranger to CMA. He has helped CMA in the past in numerous ways in conducting CPD programs. I think Dr. Nuwan also explained that part very well. With that note, I would like to thank Mr. Gary, expert on cost management and performance improvements, for the insightful presentation and sharing his experiences to educate us on predictive accounting. I'm confident that the guidance provided by him will assist all of you to enhance your knowledge and skills. Let me also thank our moderator, Dr. Nuwan Gunratne, joining with us from Australia, and for his valuable contribution and sharing his experiences. I also would like to thank our president, Professor Vatawala, for the leadership and guidance provided to organize this webinar under the CPD programs to improve the skills of our members and others. I also would like to thank all our members of SAPA member bodies and others for your participation for the webinar and the CMA team for the support extended to conduct a timely important webinar. Thank you. Take care.
So thanks, Gary, and wish you all the best. And maybe we'll see you again for another seminar if you are available. Okay, thank you, and all the very best. Thank you, and thanks everyone from all our SAFA countries. Thanks, Nuan, for your presence. Good night.
Night.
Thank you.
Good night.
Bye.
Thank you, Nuan. Nuan, thank you.
Thank you very much, Mr. Edna.
Right.
Thank you.
Okay. Thank you, Professor. Thank you all, ladies and
Thanks,
gentlemen.
thanks. Yeah, bye. Okay. Okay, remember.